Sean, good to have you back on the program. Did anything strike you over the weekend coming from these World Bank IMF meetings? Because it just seemed to be doom and gloom, talking about catastrophic risks and bank runs.
Yeah, there's certainly nothing substantive or necessarily that positive coming out of the weekend, but I think there is a little bit of a sense that politicians are starting to get how serious it is now, and at least talking about making some moves towards getting some resolution there, and importantly starting to see some talk about injecting more capital back into the European banking system. So I think we really need to see some progress there to really turn this bear market around.
Yeah, bear market, that's right. That's exactly what it is, especially when you have markets down 20% from their highs this year. You know, we heard from PIMCO's Al Arian again, talking about 50-50 chance of recession in Europe. He also talked about on the eve of being maybe a banking crisis. What are your expectations right now for the global economy?
Yeah, it's an interesting point at the moment. Certainly looking across the developed world, if not recession, certainly weaker growth there as we're moving into this position of fiscal restraint. So budget cuts, not just in the US but obviously across Europe, are going to provide a pretty material headwind for economies that are already deleveraging. So it's hard to see very strong growth coming through there, and certainly if you don't see some substantive moves to shore up the European financial system, then you do have those downside tail risks of banking crisis and a real shock. I think the upside is that we are 3 years down the track from Lehman Brothers, and the corporate landscape's improved dramatically in terms of their position of leverage and duration of debt. So we've had some good rebuilding of balance sheets. The corporate world is in a much better place to really deal with the sort of fallout from a banking crisis and weaker growth. So I don't necessarily see the big downside hit to corporate earnings that we got 3 years ago. And in that sense, equity markets, whilst they are factoring in fear, probably do look a bit cheap.
Okay, well, has a Greek default been priced in fully?
I think Greek default's probably been priced into Greek bonds, but what the market's grappling with is what are the second round contagion effects there. So certainly the haircuts that's going to give to European bank balance sheets, it probably has been priced into those share prices, but what's unknown is just the second round effects of does that lead to a run on Portugal or Ireland or Spain and Italy, and to that extent I don't think big haircuts there are priced in, and that's where you need to see some real moves to get capital into that banking system.
Yeah, you know, we hear a lot from investors and fund managers, including billionaire George Soros, saying that something needs to be done to safeguard European banks. So what is that something? Is that about throwing more cash at the problem, or what are you looking at as an investor in the markets?
I think the real issue is just the European banks are too thinly capitalised and aren't in a position to take haircuts to that capital in terms of those sovereign bonds. So I'd like to see capital raised, so either privately through rights issue, or if the market's not prepared to support it, you need government support there. Turning the stability fund into a TARP-style fund where they buy back some of that debt at a haircut, or even capital injections from national regulators. There does need to be something occurring there to get some stability back there.
Okay, so it sounds like the banking system is at risk in your view, Sean. Are we going to see a repeat of 2008, another financial crisis here?
I don't think we will, in the sense that regulators now globally are aware at least of what happens when you allow something like a Lehman Brothers, a major bank, to actually fail. The second round effects are pretty catastrophic. So I don't actually see a failure coming through, but markets are going to continue to be very weak and volatile and push regulators' hands until you see some action on that front. So I don't see a repeat of 2008, but it's certainly going to continue to weigh on markets and sentiment until we do get some resolution.